You see Netflix's stock price at $73.69, down 3.3% this month, and you're wondering if this streaming giant is still worth your investment dollars. You know Netflix dominates your living room, but translating their corporate earnings report into actual business performance? That's where most investors hit a wall. The truth isn't that earnings are too complex to understand, it's that nobody breaks down the real filed numbers in plain English. I've spent years translating SEC filings into actionable insights, and let me walk you through Netflix's latest numbers that just hit the Edgar database. Revenue, that's total sales before any expenses, came in at $12 billion for the quarter ending June 30th, up 13% year over year. But here's what most people miss: growth isn't just about the headline number, it's about the trend. Looking at the last 5 quarters, Netflix went from $10 billion to $11 billion to $11 billion to $12 billion and now $12 billion. That's not just growth, that's acceleration, and the pattern tells a story most investors completely overlook. Revenue is sexy, but net income, that's profit after every single expense, tax, and cost, is where the rubber meets the road. Netflix posted $3 billion in net income this quarter. Think about that for a second. They brought in $12 billion in sales and kept $3 billion as pure profit. That's a profit margin of roughly 27%, meaning for every dollar subscribers pay, Netflix keeps 27 cents after paying for content, technology, employees, everything. Most people think streaming is a low-margin business because of content costs, but these numbers tell a completely different story. But the third metric is where it gets really interesting for individual investors. Earnings per share (EPS) is the most important number for stock investors, and it's surprisingly simple. Take that $3 billion profit and divide it by every share outstanding, and you get $0 per share. If you own 100 shares of Netflix, your piece of the company earned $80 this quarter, or theoretically $320 annualized. With shares trading at $73, you're paying roughly 23 times annual earnings for each share. That's the real valuation story, but there's a disconnect between these strong fundamentals and recent stock performance that's creating an interesting opportunity. Here's where it gets fascinating from an investor psychology standpoint. Netflix just reported accelerating revenue growth, healthy profit margins, and solid earnings per share, yet the stock is down 3% over the past month. This disconnect happens all the time in markets. Strong business performance doesn't always translate to immediate stock gains. Sometimes it's broader market sentiment, sometimes it's investor expectations that weren't met, sometimes it's just noise. The key is separating the business performance from the stock performance, because they don't always move together in the short term. What matters for long-term investors is understanding what these trends might mean going forward. Let me paint the bigger picture using just the hard numbers from their SEC filings. That 5-quarter revenue progression I mentioned earlier, $10 billion, $11 billion, $11 billion, $12 billion, $12 billion, shows not just growth, but consistent acceleration. The year-over-year growth rate of 13% is solid for a company Netflix's size. Meanwhile, they're converting more than a quarter of every revenue dollar into profit, which suggests their business model is working efficiently at scale. These are the metrics I watch to gauge whether a company is building sustainable value or just riding temporary momentum. Based on these latest SEC filings, remember, this data comes with a reporting lag, so the most recent press release might have newer numbers. Here's what I'll be tracking. First, can Netflix maintain this revenue acceleration trend, or will growth start to plateau? Second, will they hold these profit margins above 25%, or will content spending pressures start eating into profitability? Third, how does EPS growth compare to stock price movement over time? These aren't predictions, they're simply the key metrics that will tell us if this quarter was part of a sustainable trend or just a strong quarter in isolation. Remember, this breakdown comes straight from Netflix's SEC filings, real numbers, not hype or speculation. The company is clearly profitable and growing, but whether that translates to stock gains depends on factors well beyond these quarterly results. This is educational analysis, not investment advice, and you should always do your own research before making any financial decisions. For more earnings breakdowns like this, check out nexusaicalls.com, where we translate corporate filings into plain English, quarter after quarter.